Welcome to the Ellsworth Advisors monthly update for June 2026. I'm Kelly Keenan. This is Patrick Justice, and today we'll discuss latest economic news, how our accounts have performed, how our portfolios have performed, and also what we see moving forward the next month or so. Patrick, why don't you kick us off with some economic news?
Thanks, Kelly. Good morning, everyone. For reference, today is Tuesday, July 14th. I thought it would be good today. Let's start with some of the SpaceX hype. It's been a big month, big media clickbait around that position. Obviously, it IPO'd at 135. We saw it drive all the way up into the 220s. I think it topped out around 225. But over the last couple weeks, we've seen prices have come back down. So now it's settling in that 130, 140 range. I'm still not sold on that at this time. I know you guys talked about it before. What are your thoughts? You know, there's been a lot of hype around the position. What are your thoughts on that position, Kelly?
I think there's still better prices to be seen ahead of us. The valuation on it is, very optimistic. Everything has to work right.
Yep.
And there's plenty of other opportunities out there. We don't need it in the portfolios for any specific purpose. And at these prices, I'm still hesitant to buy at these prices. It got back to its original IPO price a little faster than I thought it would.
Yep.
And, it'll be interesting to see how the addition to the indexes affects price-wise. It's definitely sucked a lot of capital out of the market into the IPO. So, we're seeing definitely some stress in the tech arena at this point in time.
Yep. Fair enough. Well, let's jump into the numbers. Starting with growth, GDP. Couple figures to report this month. According to the Atlanta Fed GDP Now, as of July 8th, second quarter GDP estimated to just 1.3%. We've seen this number fall a bit. It was in the threes for a good part of the quarter, coming down to the 1.3 range. So that's from the Atlanta Fed GDP Now. Now, dating back to the first quarter, according to the Bureau of Economic Analysis, GDP is reported to have increased by 2.1% for the first quarter of 2026. This is that third revision of the figure, and it actually did bump up by 0.5%. So there was a downward revision of imports, which, as we know, is a good thing for GDP. So sitting in that 2% range.
Yep. No, we're kind of in, call it 2% growth for the economy our size and maturity. That's okay.
Mm-hmm.
And so and that's kind of where we've been sitting, is not too hot, not too cold.
Yep. Let's talk jobs. Unemployment. According to the Bureau of Labor Statistics, on July 2nd, the unemployment rate sits at 4.2% still. We've added 57,000 non-farm payroll positions during the month. If we do widen that lens a little bit, it stayed pretty steady over the last 12 months. I looked back and it's anywhere between 4.1 to 4.5. So although there's been stressors, there's, overseas conflict, a lot of things happening in the world, jobs have been pretty steady for us.
Yeah, it's, we talked about being a bit of a transition for labor with, changes with AI, but then also you have a situation with immigration being highly limited.
Mm-hmm.
That changes the amount of workers and then jobs that are being offered. So a lot of, shifting landscape in the unemployment world. I mean, the one thing we know is the way we're measuring it has remained fairly steady the last 12 months after immigration reforms were put into place. With the new Fed chair, Kevin Warsh, coming in, he's a little bit critical of the data that the Fed uses for some of its measuring. And one of those areas where, is there a better way to measure unemployment is a big question mark. Will he try to implement a new way to measure unemployment? Why not? I mean, if there's a more accurate way to do it,
sure.
It's all about, consistency. We've always used the same metrics to measure. If we need to change to a new metric to measure, be consistent with it moving forward. The one thing is, how do you translate? How does that relate to the old data? And that number series could obviously change in a transition in that type of situation. But hey, if we're in a mediocre, wouldn't call it mediocre, a decent economy where, hey, we have good GDP growth. Seems like unemployment's stable. Now, maybe not a bad time to make some changes moving forward. We'll see.
Yeah, totally fair. I'm going to jump to a couple comments from the Warsh, his first Fed meeting as well. I was really encouraged by what he had to say. I thought he, as you mentioned, he's thinking big picture. He's thinking about using different sources. I did want to bring up, he's assigning 5 task forces as trying to move the Fed ahead or trying to think differently. So just to run through those really quick. One is Fed communication, how they communicate with the public and also with the public markets. 2 is Fed balance sheet. The management of the balance sheet. Are we going to shrink it? I think that's sort of what he's alluding to. Data sources, as you just mentioned, which I like a lot. You think about, I just referenced the GDP revision. We wait months and months for those items.
Right.
As he talked about, we have private sector data from, big payroll companies, et cetera, that they are hoping to get quicker data to make very tough decisions for our economy.
Right.
So I love a lot of what he said there. 2 other items that he mentioned for task forces, productivity and jobs, alludes a lot to the AI and the changing workforce that we talked about. And finally, an inflation framework. There's a stated goal of 2% for inflation, maximum jobs as well. We'll see if there's any tweaks there. They pressed him a little bit in the press conference on that.
The problem with inflation is there's so many different ways to measure it, and all these different methods. Well, if we take out this and we don't, shouldn't count because it's too volatile, and this should count here. You can make it say whatever you want to say.
Yep.
So, okay, once again, consistency is going to be key moving forward. I believe we're, definitely in a, we're not in a 2% inflationary environment. Probably realistically more in the 3 range.
Yep.
The changing dynamics in Iran, where the war is kind of heating up a little bit. We're seeing oil prices get back up again. That is going to cause higher inflationary numbers.
Big time.
So, but will the Fed increase rates because of this? I don't think so. I think it's kind of, let's wait and see. They're not going to reduce rates. I'm pretty sure of that. And where interest rates are right now kind of makes sense based on kind of where we've been floating around inflation-wise. So I see not a whole lot changing interest rate-wise. You could see some changes with the balance sheet of the Fed.
Yeah.
So
fair. Couple other data points. Sorry, I hopped around, but I wanted to comment. I really like the worst comments. Few other inflation data points from a PCE or personal consumption expenditure index. As a reminder, that measures the change in prices consumers spend on goods and services. On June 25th, the Bureau of Economic Analysis reported the index rose 0.4% for the month of May. This is consistent with what we saw in April as well. If we strip out food and energy, index was steady at 0.3% in both April and May. From a PPI index standpoint, our producer price index on June 11th, Bureau of Labor Statistics reported the index rose by 1.1% on a seasonally adjusted basis in May. It's the same monthly change of 1.1 from April as well. I will notate the unadjusted year over year was pretty hot at 6.5% for May. Not surprising given a lot of the overseas conflict that we're seeing right now. One final point on inflation data from a CPI or consumer price index. On June 10th, Bureau of Economic Analysis reported all items CPI rose by 0.5% in May on a seasonally adjusted basis after a 0.6% bump in April. Year over year, index increased by 4.2%, and this is a bit of an increase once again. It was 3.8 in April. We see 4.2 year over year in May. So, if we do strip out food and energy, once again, this is a telltale sign. If we strip out the volatile food and energy, CPI increased at a mere 0.2% in May. So there is a ton of movement from what we're seeing going on in the world.
Well, it's elevated because of energy prices. So by raising rates, that's not going to stop that down.
Correct.
But then again, the other side of it is, okay, up 0.2 in May, annualize that, you're looking at 2.5%, 3%.
Yep.
Okay, it's still too high to reduce rates.
Yep.
So
Totally fair.
kind of takes us to right where we're at.
Yeah, absolutely. The last point was just that they did decide at the last meeting they are going to leave that Fed funds rate at 3.5 to 3.75. That's unchanged. And I totally agree with you. I think they sit tight with rates at this time.
Let's talk about the portfolios a little bit, the markets. So in June, the Bloomberg U.S. Aggregate Bond Index was actually up 0.24%. So we had rates come down a little bit. Year to date, that index, the bond index is only up 0.62%. So with rates, kind of going, more trending up and down, that's kind of definitely hurt the aggregate bond index. S&P 500 for the month was down 0.95%. We had a strong May, kind of a little bit of a give back in June. Year to date, the S&P though is still up 10.21%. The NASDAQ for the month was down 2.75%. Year to date, NASDAQ still up 13.13. The Dow Jones actually made money this month, or was up this month, up 2.71%. So more defensive stocks, non-tech related, actually had a good month. That takes the Dow up to 9.76 for the year. The Russell 2000, which measures small cap stocks in the U.S. for the month, a good month there, up 3.74%. Year to date, up 22.57. So a good year for small caps. On the international front, the MSCI EAFE for international stocks for the month up 0.09. So we've seen international stocks cool off a little bit. Year to date, up 9.84%. And emerging market stocks for the month down 1.36. Year to date, up 24.02 for the year. So once again, it was kind of a little bit of a give back from a strong May. Moving into this month, we also saw a decent amount of rotation, and we'll see that in the portfolios. The dividend yield portfolio, which is more defensive, for the month we were up 4%, year to date up 12%, so kind of picking up some ground there. Gainers for the month: Johnson & Johnson, PNC Bank, U.S. Bank Corp, Old Republic. Laggards: Chevron down 9%, Pepsi down 6%, Cisco down 3%, and actually AT&T down about 15%, at least until we sold it. So once again, kind of more defensive names. The financials did well. You're seeing, the energy down for the month, and then some tech down for the month. Year to date, Cisco up 52, Altria up 25, Johnson & Johnson up 23, Public Storage up 23. Laggards for the year: Medtronic down 19, Pepsi down 6, Old Republic down 5. The growth with income portfolio for the month down 2.5%, year to date up 7. Where we had gainers in there: Caterpillar up 22 for the month, Johnson & Johnson up 13, Berkshire Hathaway up 5. Where we felt pain in here, we are gold position down 12%, Toyota down 11%, Nike down 11%, Nucor down 11%. Year to date, Caterpillar still up 86%, Microchip Technology up 43, Nucor up 37 for the year, and EOG up 24 for the year. Once again, laggards: Nike down 34, Toyota down 21, Disney down 15, Lennar down 12. So definitely feeling, not a great month for growth with income. I think by its nature, we tend to be more balanced in there. And, just the pullback in gold, I think, in really commodities, it was, really where we felt most of the pain in the growth with income. Our appreciation with income portfolio for the month up 3%, year to date up 14.69. Big gainers in June: Lam Research up 36, Amphenol up 19, CVS up 14, Eli Lilly up 8. So seeing a little bit of action in healthcare there. Laggards: Microsoft down 17, Broadcom down 15, Meta down 11, Huntington Ingersoll down 9%. So pain in the in the software space and the chip space. Not that was a drag on the portfolio, and kind of the same rotation you're seeing within the market itself in June. Price potential portfolio has been one of our hotter portfolios year to date. For the month, down 2%. Once again, laggards being Microsoft down 17, Petro Brazil down 14, Amazon down 12, BP down 12, Meta down 11. So we had both tech or really software and energy, dragging it down. Where we did make money, Marvell, once again, another chip company, up 45%, AMD up 13%, Jones LaSalle up 12%, Arista Networks up 6%, Eaton Corp up 6%. Small cap portfolio, like I said, small caps have been quietly doing well. Our small cap portfolio up 8% for the month, year to date up 26%. Big gainers being Elliott up 30% for the month, Gorman Rupp up 22% for the month. Douglas Dynamics up 21% for the month. Spire Pharmaceuticals up 21% for the month. Laggards being Navigator Holdings down 14 and Sorozen down 1. Obviously, when you're up 8% for the month, not a lot of losers, so that's all right there. One of our newer portfolios, our Timely Quality portfolio in June is up 10%, year to date up 24%. Once again, gainers being Applied Materials up 61% for the month, Lamp Research up 36% for the month, Caterpillar and Parker Hannifin up 16%. Laggards, Adobe down 21%, T-Mobile down 11%, Google down 6%. So really, what I read out of this is we had some rotation through the month. Definitely sectors and industries aren't necessarily running in sync, or if you're buying tech, not all tech is alike. Software is behaving differently than chips, and even the individual companies in each category are behaving differently. So, it's all about individual stock selection, which, obviously that's what, our approach is bottoms up, analyze company fundamentals first per company, and then choose companies we want to be invested in. And, if we're overweight in certain industries, that's when we'll cut things back. But the reality is quality fundamentals is going to be key, and, diversification. Don't get too heavily weighted in tech at this point. We just don't like the valuations.
Yeah, I think we've seen, as you talked about, a ton of rotation. Right. We are seeing one day chip makers good.
Yep.
The next day bad. One day software good. Next day bad. So it's things are moving quick, and it's a bit of a whipsaw in there. But I totally agree with you. Quality wins over time, and that's what we want to hold in our models for our clients.
So June was actually for our portfolios, we made money. It was a decent month. July and August tend to be the weakest months of the year. That's when your volatility comes in. I think we've been seeing it the last 2 weeks already. It's not going to stop the next, I think at least through August. And the reality is September, October, we're rolling into a midterm election. Yep. So you have to expect a little bit of rumbling around there. But, once we get through there, I think the big picture economic stuff isn't going to change a whole lot, which would argue towards, strength into the end of the year. So it's kind of how things are looking.
I agree. Like I said, I mentioned a couple times, but I'm very encouraged from what I heard from Kevin Warsh. I think he is, he has his eye on the prize of what they want to do at the Fed and making sure people are working and we have prices under control in this country. I know it's a big problem for everyone, and I'm comfortable where we sit on our end, and
we'll be able to
keep on chugging.
We'll be able to navigate whatever he throws at us.
Absolutely.
Bottom line.
Absolutely.
Thanks for joining us today, and you have a great month.
Thank you.
Thank you.